All right, picking up where we left off here on the Chapter 13 presentation, we're on slide 51 for the current cash debt coverage ratio. And for this, we need to use the net cash provided by operations from the statement of cash flows divided by average current liabilities. So on the slide, they failed to use that term current in describing the ratio, but that's really what it is. And the reason for that distinction to be made is that there is another cash debt coverage ratio in the solvency ratios that we'll cover in a bit that's longer term in nature. So it's important to make that distinction between the two. Let's review the calculation of this ratio for 2009. It would be the 1,503,000 net cash provided by operations divided by the 4,036,000 average current liabilities to equal 0.37, with the 4,036,000, the average of the current liabilities balances of 4044 in 2009 and 4020 in 2008. You notice that they had the thousands chopped off in the text examples. So as we go through here, I'm just going to run through the calculations on each of these real quick, and you'll catch it on the slide itself too. So no worries there. It'll be, I think, easier for you to follow actually on the slide, but I will talk you through it. Slide 52, the receivables turnover ratio was covered in Chapter 8. Here, Chicago Serial is not doing as well as General Mills or the industry average. Remember, the higher this ratio, the better, as it indicates how quickly receivables are collected. The calculation for 2009 is 11,776 net sales. We have to assume they're all credit sales. We were not told otherwise. Divided by 985.5 average receivables equals 11.9 times. The average receivables was 1026 plus 945 divided by 2 equals 985.5. And again, the exercise assumes that the receivables balances shown are net of allowance for doubtful accounts. Slide 53, the average collection period is simply 365 days divided by the receivables turnover ratio. This is an indicator of how effective a company's credit and collection policies are. Since Chicago was over 30 days both years and the industry average and General Mills are both in the 20s, it looks like Chicago Serial could use some extra attention to this area. The calculation for 2009 is 365 divided by 11.9 will equal the 30.7 days. Slide 54. The inventory turnover ratio is a measure of how many times the average inventory was sold during the period. In this case, Chicago Serial comes out on top with a higher ratio than either General Mills or the industry average. The calculation for 2009 is 65.97 cost of goods sold divided by 874 average inventory equals 7.5 times. The 874 average inventory is 924 plus 824 divided by 2. You can see all these numbers as you look through the financial statements that are shown in the text. Slide 55. The days in inventory ratio is similar to the average collection period for receivables. This ratio is a measure of the average selling time for the inventory. In Chicago Serial's case, they are selling their inventory on average faster than either General Mills or the industry average, which is a good thing. Calculation of the 2009 ratio, 365, divided by the 7.5 inventory turnover ratio will equal the 48.7 days. Slide 56. Next we move into the solvency ratios that measure the company's ability to survive in the long run. This consists of ratios measuring longer-term debt paying ability and the free cash flow. And on slide 57, the debt to total assets ratio is simply total liabilities divided by total assets. The figures for Chicago Serial tell us the following. One, they have improved solvency between 2008 and 2009, as evidenced by the ratio decreasing. And 2, they still don't look that good compared to the industry average or even to General Mills. Calculation of the 2009 ratio, 8871 total liabilities divided by 11,397 total assets equals 78%, which is a rounded figure. On slide 58, the times interest earned ratio shows how many times over the company can meet its interest payments. In Chicago Cereal's case, this ratio is 5.8 for both years, indicating that they can cover their interest expenses about 6 times over. Although this is lower than General Mills, it's pretty close to the industry average. Excuse me. And as the slide points out, overall the company is better able to service its debt because while this measure stays constant, the debt to total assets ratio decreased between the 2 years. Calculation of the 2009 ratio is 1103 net income plus 319 interest expense plus 444 income tax expense divided by 319 interest expense equals 5.8. Slide 59. Here's the non-current version of the cash debt coverage ratio, in which the numerator is the same as for the current cash debt coverage ratio covered in the liquidity section, but the denominator is now the average total liabilities instead of current liabilities. In this case, the higher the ratio, the better, and Chicago's is better than General Mills. See the interpretation note above as to why a higher ratio is better. The calculation of the 2009 ratio is 1503 net cash provided by operations divided by 8758 average total liabilities equals 0.17. And the average total liabilities is for 2009 4044 plus 4827, and then for 2008 4020 plus 4625, and all of that divided by 2 equals 8758. Slide 60. The free cash flow ratio measures the company's ability to pay dividends or make capital expenditures to expand or improve operations. In Chicago's case, they seem to be in pretty good shape, although somewhat less free cash flow than General Mills. The calculation of the 2009 amount is 1503 net cash provided by operations minus 472 cash purchase of PP&E, that comes off the statement of cash flows, minus 475 dividends, again off the statement of cash flows, equals 556. Slide 61. Finally, return to the profitability ratios. This chart shows the relationships between them, which we'll get into a little bit as we cover these ratios. On slide 62, the return on common stockholders' equity ratio basically shows how many dollars the company earned for each dollar invested by the common shareholders. Note that preferred stock dividends are subtracted from the net income so that only the earnings that are available for common shareholders are included. In Chicago's case, they are in very good shape here compared to both General Mills and the industry average. The calculation of the ratio for 2009 is 1103 net income divided by 2297.5 average common stockholders' equity equals 0.48 or 48%. There's no mention of preferred stock or preferred dividends, so we have to assume that there are none. Slide 63, the return on assets ratio, is another profitability measure showing how much income was earned on the dollars invested in company assets. In Chicago's case, their ratio is better than General Mills or the industry average. However, the text makes a bigger deal out of the relationship between this ratio and the return on common stockholders' equity of 48%, saying that this shows Chicago's effective use of leverage, that is, using other people's money to make money. The calculation of the 2009 ratio is 1103 net income divided by the sum of 11,397 plus 10,714 divided by 2 equals 0.1 or 10%. Slide 64, the profit margin ratio measures the percentage of each sales dollar that results in net income. So it's just net income over net sales. For Chicago, they didn't fare quite as well here as either General Mills or the industry average. Remember from before that although Chicago had a better gross profit margin than General Mills, they were about even at the bottom line. The calculation of the 2009 ratio is 1103 net income divided by 11,776 net sales equals 0.094 or 9.4%. And remember, it's from your math classes, hopefully you know how to convert a decimal to a percentage. Very important. Slide 65. The asset turnover ratio is a measure of how efficiently the company uses its assets to generate sales. For Chicago, they fare slightly better on this ratio than either General Mills or the industry average, since the higher the better in this case. Calculation of the 2009 ratio, 11,776 net sales divided by 11,055.5 average total assets equals 1.07, again rounded to the nearest second place. On slide 66, this slide shows how a couple of different ratios can be combined to produce another meaningful measure, that is, return on assets, which is the net income divided by average total assets. By taking the profit margin and multiplying that times the asset turnover ratio, we can get the return on assets ratio in the same way that we could calculate it originally. By doing it as shown on this slide, we can see the combined effects of the other two ratios on the return on assets ratio. On slide 67, as we've seen before, the gross profit rate is simply the gross profit amount divided by net sales, and Chicago was ahead of General Mills and the industry average on this one. And on slide 68, earnings per share, or EPS, is an important measure of profitability that is included in the income statements of publicly traded companies. Again, the focus is on common stock, so an adjustment needs to be made to remove preferred stock dividends, if any. In Chicago's case, they have what appears to be a fairly healthy EPS, although there is no industry average with which to compare, and General Mills is somewhat higher. The calculation of the 2009 EPS is 1103 net income divided by 418,600 average common shares outstanding equals $2.63. And again, the 1103 is really 1,103,000. So that's how that one comes out. Slide 69. The PE ratio, again, is a measure of how valuable the company's stock is relative to earnings. The greater the ratio, the more favorably the company is looked at by the market. Whether or not this is justified is another question, as is noted above with the comment that the stock could be overpriced, given the company's real performance. In Chicago's case, their PE ratio is pretty healthy in comparison to the industry average and to General Mills. The calculation of the 2009 PE ratio is the $52.92 price per share divided by $2.63 earnings per share, or EPS, equals 20.1. And on slide 70, the payout ratio, which was covered in the chapter on stockholders' equity, is simply a ratio of the cash dividends declared on common stock divided by net income. In Chicago's case, they are right there with General Mills and slightly above the industry average. Trend analysis for this ratio may be useful, as noted on the slide, because the board will want to know if the dividend payouts may need adjusting from time to time based on current conditions. The calculation of the 2009 ratio is 475 dividends paid divided by 1103 net income equals 0.43 or 43%. And finally, it wouldn't be complete without the slide on IFRS. And again, no quiz or test coverage. And the slide basically says there are no significant differences for the material covered in this chapter between GAAP and IFRS. Enough said. And with that, we'll wrap up the Chapter 13 presentation.